back to Wealth Wednesday. My name is Bryant Stone, Chief Investment Officer of Polimeni Tax and Financial Group. Appreciate you guys coming on. Last week's episode, we talked about being smart with your money. In the weeks prior to that, and kind of kicking off Wealth Wednesday, we've focused a lot of time really on trying to find ways to get yourself in a position where you can actually start investing, start creating wealth. So now what we're going to do, guys, is we're going to transition into different vehicles that you can put your money into to start creating wealth, to start building retirement accounts, things of that nature, okay? And one of the most easiest vehicles and simplest, and a lot of you probably do have it, is what's called a traditional IRA, okay? So a traditional IRA, the acronym IRA stands for an individual retirement account. A lot of you, like I said, probably do have it either through your employer or maybe you set one up on your own in the past. And it's simply a way for you to create money for your retirement, right? Individual retirement account. And with a traditional IRA, the money that you're actually going to put into that is going to be pre-tax dollars, meaning that the money that goes into it, you can write it off on your tax return. So if you put in $5,000 into a traditional IRA, you can reduce $5,000 from your taxable income. And then also the investments that are inside that traditional IRA are also going to grow tax deferred. So if you see yourself in retirement in a lower tax bracket, maybe a traditional IRA may be for you, right? Because now all that money that you're pulling out, you'll pay tax at that time. If you're in a lower tax bracket, that will benefit you, okay? So in relation to that, what we're going to talk about is your contribution limits. So in 2021, if you want to contribute to a traditional IRA, like on your own, personal, and you're under the age of 50, the maximum that you can contribute is $6,000, so about $500 a month. And if you're 50 or older, you can contribute $7,000. So an additional $1,000 on top of that $6,000, they call that the catch-up, okay? Now, the type of investments that are going to go into a traditional IRA, and there's a lot of different types of investments, but the most common type you're going to see are stocks, bonds, ETFs, mutual funds. Those are your most common types of investments that are going to go into a traditional IRA. Now, something to be careful with the traditional IRA and just an IRA in general is that if you do take money from that IRA before 59 and a half, you would be subject to a 10% tax penalty. Now, there are some rare circumstances where that 10% tax penalty would be waived, but for the most part, if you pull out any money from that traditional IRA before you're 59 and a half, you're going to be subject to a 10% tax penalty. So if you do have an IRA, before making any type of distributions, make sure you're consulting with your tax advisor, with your financial advisor, so you're making smart decisions, okay? Now, going along with the premise of distributions, let's say you're in retirement now, you have this traditional IRA and you need to help use that to supplement income in retirement, those distributions are going to be counted as ordinary income. So whatever your tax bracket is at that time, that's going to count as taxable income. You'll have to pay taxes on that, okay? Another thing to be cognizant about with a traditional IRA is that when you hit 72, you must take out what's called required minimum distribution. Now, I'm not going to get too in-depth on the required minimum distribution, but the easiest way to look at that is that the government says we've allowed you to defer your taxes on this investment, on this pool of money from all these years. At 72, you're required to take out a certain amount of that money from all your tax-deferred accounts, okay? It can be in a traditional IRA comes in a lot of different forms, 401ks, 403bs, TSPs, 457s, 401s. There's a lot of different types of traditional IRAs, but the main premise behind it is it's a tax-deferred vehicle, okay? Now, going along with the tax concept is that, your contributions are fully tax deductible in a traditional IRA if you and your spouse are not covered by an employer-sponsored plan, okay? If you are covered by an employer-sponsored plan, you or your spouse, there's certain limits that you have to be cognizant of and be aware of as far as what you can contribute to a traditional IRA. So those are things that if that's something that you feel may be right for you, please consult with your financial advisor. Please consult with your tax professional to make sure that you're making smart decisions, you're making the correct elections. But that is one vehicle that you can generate wealth with, you can invest in to create assets for retirement. And once again, appreciate you guys coming on. We'll see you again next week.